The RV lifestyle once stood for freedom, wide highways, campfires, and endless adventure. Now it's fear that drives the industry. Fear of bankruptcy, layoffs, and a market on life support. High prices, high rates, and low demand have crippled it. Today, we are revealing the brands standing on the edge of extinction. Let's get rolling. First up, a name everyone knows, but few realize could be in real danger. Airstream, the beloved maker of those shiny silver bullet trailers, is part of Thor Industries and still has brand cachet. While its parent company reported modest growth in some segments recently, several warning signs suggest Airstream could struggle ahead. The broader RV industry is cooling, particularly for high-end models. Thor reported motorized RV sales dropped about 11% in fiscal 2025. That's a problem for Airstream, which sells premium-priced trailers. We're talking luxury recreational vehicles that appeal to discretionary buyers. In today's economy, three factors create risk. First, higher interest rates make expensive RVs harder to afford. Second, Airstream offers financing up to 20 years, which seems generous but becomes problematic when rates climb. Buyers stretch budgets thin, increasing default risk. Third, when demand softens, premium brands face inventory headaches. Dealers can't move units without steep discounts, which crushes profit margins. Airstream isn't collapsing, but it's more vulnerable than mass-market RV brands. Luxury purchases get cut first when wallets tighten. If economic uncertainty persists through 2026, Airstream's high price positioning and long financing terms could turn from strengths into liabilities. The silver bullets may lose some shine. Jayco is a major player in the US RV market with a broad lineup spanning affordable towables to pricey motorhomes and fifth wheels. Despite strong quality ratings and manufacturing muscle, Jayco faces real vulnerability in an economic downturn. The problem starts with its product mix. Higher-end motorhomes and fifth wheels get hit hardest when interest rates rise or consumer confidence drops. These are big-ticket discretionary purchases that buyers delay or cancel when budgets tighten. Industry trends reveal deeper concerns. Early 2025 data showed new RV sales down nearly 9%, even as manufacturers shipped 14% more units. That mismatch signals trouble. Dealers are receiving inventory they can't sell, suggesting manufacturers are out of sync with actual demand. When dealers anticipate weaker sales, they stop ordering, creating a ripple effect that squeezes manufacturers like Jayco. External factors amplify the risk. High interest rates make RV loans expensive. Rising fuel costs discourage road trips. Economic uncertainty keeps checkbooks closed. Jayco's scale and reputation help, but don't provide immunity. When the RV market contracts, as it's doing now, even strong brands feel the pain. If the slowdown continues into 2026, Jayco may be forced to scale back production or cut model lines to survive. Jayco's exposure to premium segments and macro-sensitive buyers means a prolonged downturn could significantly impact its business. Winnebago, a household name in RVs, is actively signaling trouble. Unlike competitors still projecting optimism, Winnebago's recent financials tell a stark story. In Q3 2025, revenues dropped to $775 million, down 1.4% year-over-year. More alarming, gross profit fell 10.3% to $106 million, with margins compressing to 13.7%. That margin squeeze reveals the real pain. Winnebago is earning less on each unit sold. The core problem? Winnebago leans heavily on large, expensive motorhomes, Class A, B, and C models, precisely the products consumers abandon first when economic uncertainty hits. The company explicitly blamed weaker demand, high interest rates, and consumer caution. Dealers are right-sizing inventories, code for "we ordered too much and can't sell it." This creates a vicious cycle. Slow-moving inventory forces discounting, which crushes margins. Reduced dealer orders mean factory slowdowns. Higher warranty and aftermarket costs add pressure. Meanwhile, financing costs keep potential buyers on the sidelines. Why commit to a $150,000 motorhome loan at today's rates? Winnebago's risk level is elevated. If the RV downturn deepens or a mild recession takes hold, its exposure to premium motorhomes could accelerate decline. The company isn't hiding the struggle. The numbers speak clearly. Winnebago faces serious headwinds ahead. And if you think it stops there, wait until you hear what's happening to America's biggest towable RV producers. Keystone, owned by Thor Industries, ranks among America's largest towable RV makers with popular brands like Cougar, Montana, and Hideout. But size isn't protecting it from serious trouble. Thor's 2025 financials paint a grim picture. Overall sales down 4.7%, with profits plunging across its North American towable division. Keystone's central problem is market oversaturation. Too many mid-priced trailers chasing too few buyers. Interest rates above 7% are crushing financing approvals, leaving dealers stuck with bloated inventory they can't move. The numbers confirm weakness. Towable retail registrations dropped 6.2% in April 2025 compared to the prior year. Meanwhile, Keystone faces rising production costs, up roughly 9% over 2024 levels, driven by expensive materials and warranty part supply issues. Profit margins are getting squeezed from both sides. Analysts predict consolidation is coming. Thor may discontinue or merge some Keystone sub-brands to cut costs and streamline operations. Here's the paradox. Keystone's massive scale worked beautifully when demand was strong, but now makes the company slow to adapt. If consumer spending stays tight through 2026, expect Keystone's sprawling model lineup to shrink significantly. In a contracting market, being the biggest doesn't guarantee survival. It can mean you fall the hardest. Coachmen, a veteran American brand under Forest River, weathered the 2008 recession, but faces tougher challenges in 2025. Today's environment is different. Buyers are over-leveraged and crushed by record insurance, fuel, and campground costs. The numbers tell the story. Coachmen's Class C motorhomes, once a reliable mid-range segment, saw registrations plunge 15% in 2025, according to RVIA data. Dealers are holding inventory longer and slashing prices to move units, which damages brand value and profitability. Coachmen faces multiple headwinds. Aging designs and lower manufacturing innovation put it behind competitors like Grand Design. Since 2023, rising material costs forced retail prices up by an average of $6,000 per unit, pushing budget-conscious buyers toward cheaper used inventory instead. Meanwhile, slower loan approvals and tighter dealer credit lines choke off sales. Forest River's diversification might absorb some losses, but Coachmen specifically struggles. Its once popular models now look outdated, and the brand lacks the innovation pipeline to compete effectively. Without a major rebrand or updated lineup, several Coachmen models could quietly disappear by 2026. Survival isn't guaranteed just because you've survived before. Dutchman, owned by Thor Industries, produces affordable towables like the Aspen Trail and Kodiak lines. Being budget-friendly once meant consistent sales, but 2025 proves even entry-level models aren't safe when credit markets tighten. Dutchman's core customers rely heavily on long-term RV loans, often 15 to 20 years, that are now financially toxic due to high interest rates. Many buyers simply can't afford the monthly payments. Dealers report dramatically slower traffic, with shipments down roughly 10 to 12% year-to-date compared to early 2024. The thin margin problem is critical. Unlike luxury brands that cushion downturns with higher per-unit profits, Dutchman operates on razor-thin margins. Any volume drop pushes the brand dangerously close to unprofitability. The biggest red flag, parent company Thor is consolidating manufacturing lines to cut costs. In corporate triage, low-margin brands like Dutchman typically get axed first. Dutchman's reputation for lower build quality also hurts resale values, making potential buyers even more hesitant. Without aggressive restructuring or brand reinvention, Dutchman could vanish entirely by 2026. Budget pricing can't overcome unaffordable loans. Heartland, known for fifth wheels and toy haulers like Cyclone and Bighorn, faces serious trouble. Parent company Thor Industries bluntly acknowledged that recreational towables are oversupplied relative to retail demand. Corporate speak for, "We made too many and can't sell them." Heartland's core buyers, outdoor active families and part-time RVers, have drastically shrunk since 2021 as fuel and campground prices surged. The lifestyle that justified buying a $100,000 plus fifth wheel suddenly costs much more to maintain, and buyers are backing away. Dealer feedback reveals an ominous trend. Floor plan loan delinquencies are rising. This means dealers can't move units fast enough to pay back the financing they use to stock inventory. a classic warning sign before brand collapse. Heartland's premium positioning is backfiring. With overall U.S. RV sales down 8 to 9% in 2025, luxury buyers are either downsizing to smaller rigs or exiting the market entirely. High-end fifth wheels priced above $100,000 are particularly stagnant. Unless Heartland pivots to smaller, fuel-efficient designs, plant closures could hit in 2026. Being premium doesn't help when the premium customer disappears. And now, let's move into the mid-tier brands, the ones that once looked unstoppable. Grand Design exploded after 2012 with quality-focused lines like Reflection and Imagine, becoming an industry darling. But that rapid growth now collides with harsh reality. Parent company Winnebago's latest financials show towable sales down nearly 7% year over year, and Grand Design dealers are overstocked. Grand Design's fundamental problem: it occupies the middle ground between luxury and value, precisely the space that vanishes during economic downturns. Buyers who can't afford high-end units trade down to cheaper brands. Affluent consumers either upgrade to motorhomes or delay purchases altogether. The middle disappears. Warning signs are multiplying. Production slowdowns in Indiana have already reduced factory hours, signaling upcoming cutbacks. Winnebago's CEO admitted in late 2025 that dealer destocking and affordability concerns continue pressuring the towable segment, corporate code for dealers can't sell what they have. If interest rates remain elevated through 2026, Grand Design may be forced to slash production or trim model lines to stabilize cash flow. Quality reputation helps, but doesn't protect against macroeconomic forces. The irony is painful. Grand Design succeeded by offering premium quality at reasonable prices. Now that middle market position could be its downfall. Monaco, once the crown jewel of luxury Class A motorhomes, now faces potential extinction. Part of the struggling Rev Group, Monaco's ultra-premium positioning has become a liability in 2025's high-rate environment. The numbers are devastating. Class A motorhomes, Monaco's specialty, saw registrations crash more than 20% year-to-date, according to statistical surveys. These massive rigs often exceed $400,000, and rising interest rates have essentially eliminated that buyer pool. Few people finance a near $500,000 recreational vehicle at 8+% rates. Monaco's problems run deeper than economics. Limited innovation and reliance on older platforms like the Roadmaster chassis make it less competitive against newer tech-integrated models from competitors. REV Group has already downsized other luxury brands, and Monaco's tiny market share makes it an obvious candidate for phase-out. The brand carries one of RV history's most storied legacies, but nostalgia doesn't pay bills. Unless luxury demand rebounds dramatically by 2026, Monaco may vanish quietly, remembered, but no longer rolling. Fleetwood, another REV Group brand, once dominated motorhomes, but now bleeds market share to Winnebago and Tiffin. REV's 2025 earnings call revealed declining profitability in its recreation division, citing continued weakness in Class A and Class C demand. The cost crisis is severe. Fleetwood's manufacturing costs ballooned 12% since 2023, while dealer orders plunged by double digits. High-priced models like Bounder and Discovery sit unsold on dealer lots for months, expensive inventory tying up capital and floor space. Fleetwood's core customer base, retirees and long-term travelers, are increasingly cautious. Fixed incomes don't stretch as far amid inflation, and discretionary purchases like $200,000 plus motorhomes get postponed or canceled entirely. Competition intensifies the pressure. Fleetwood competes directly with more innovative models from Thor's Integra and Newmar, brands investing in modern features and technology. Fleetwood's aging designs look dated by comparison. REV Group faces a strategic decision: continue supporting Fleetwood as a standalone brand or merge it into a unified lineup to cut overhead. The latter seems increasingly likely. By 2026, expect Fleetwood's model lineup to shrink dramatically. Some iconic nameplates may survive, but the brand's glory days, when Fleetwood meant American RV excellence, are definitively over. The company didn't innovate fast enough. East to West is Forest River's budget-focused brand, created to capture price-conscious buyers. Its simple, low-cost towables grew rapidly between 2019 and 2022, but that success story has reversed sharply. The affordable RV category, east to west's entire market, has been devastated by interest rate hikes. Lower-income buyers who once qualified for loans now can't get financing at all. When your customer base literally can't buy your product, business models collapse quickly. Dealers report painfully slow turnover and rising storage costs for unsold east to west units. Because the brand operates on razor-thin profit margins, even small drops in sales volume push operations into the red. There's no cushion. Forest River has already shifted production capacity to higher margin lines like Rockwood and Flagstaff, effectively deprioritizing east to west. In corporate resource allocation, brands that don't generate profit get starved of investment, a self-fulfilling downward spiral. The economic fundamentals aren't improving. Unless interest rates drop dramatically by 2026, unlikely given persistent inflation, east to west's customer base remains locked out of financing. This sub-brand could be folded or mothballed to conserve resources. Forest River will protect its profit generators. Budget brands with negative margins become expendable. East to west's rapid rise may be followed by equally rapid disappearance. Palomino, part of Forest River, specializes in entry-level travel trailers and truck campers, targeting the sub-$30,000 buyer range. That positioning made sense in low-rate environments, but has become a fatal weakness. The sub-$30,000 buyer demographic is precisely the group most devastated by rising loan rates. These buyers have limited budgets, lower credit scores, and fewer financing alternatives. When rates spike, they're the first locked out of the market. Inventory movement tells the story. Many Palomino models have sat on dealer lots over 180 days, far exceeding industry averages. Dealers are demanding factory rebates to move units. When manufacturers must subsidize sales through rebates, it signals systemic oversupply and dying demand. Retail sales volumes dropped roughly 9% in early 2025, pressuring already thin margins. Forest River's strategy appears to be keeping Palomino operational as long as it contributes volume, regardless of profitability, a dangerous game. If 2026 brings continued consumer tightening, Palomino faces layoffs or factory idling as Forest River prioritizes stronger performers like Salem and Cherokee. The brand lacks differentiation beyond low price, and price alone can't overcome unaffordable financing. Palomino survived past downturns, but this environment, combining high rates with over-leveraged consumers, may prove different. Entry-level doesn't mean safe. Gulfstream remains one of few family-owned RV manufacturers, a distinction that once meant agility, but now means vulnerability. Without corporate backing or conglomerate resources, Gulfstream struggles to absorb cost spikes in materials, logistics, and labor that larger competitors weather more easily. Industry insiders estimate Gulfstream's unit production is down about 14% year-to-date, and its retail footprint continues shrinking. Dealers are dropping the brand or reducing floor space allocation. Gulfstream has loyal fans who appreciate its independent spirit. But loyalty doesn't overcome fundamental disadvantages. Dated interiors and limited marketing budgets hinder growth in a market dominated by well-funded conglomerates like Thor, Winnebago, and Forest River. The used RV glut compounds problems. Many buyers can find 2021 to 2022 models, often Gulfstream's own products, for 40% less than new units. Why pay full price when slightly used inventory offers massive discounts? Without major reinvestment or a strategic partnership, Gulfstream could be forced to sell assets or halt production by 2026. Being independent is romantic until you need capital, economies of scale, or dealer network leverage. Family ownership means passionate leadership, but limited financial runway. If the downturn extends through 2026, Gulfstream may need to choose between selling to a conglomerate or closing entirely. Newmar builds high-end motorhomes under the Winnebago umbrella, including prestigious lines like Dutch Star and Ventana. The brand represents quality and luxury, positioning that worked beautifully until 2025. The luxury motorhome market is now 2025's most volatile segment, with registrations down 21% year-over-year. High borrowing costs have decimated the financing pool for six-figure recreational vehicles. dealers report multi-million-dollar inventory aging beyond 270 days, industry code for can't sell them at any reasonable price. Newmar maintains excellent build quality and brand prestige, attributes that matter in strong markets. But prestige doesn't pay for unsold inventory sitting in dealer lots. Winnebago has already warned of continuing softness in the premium motorhome segment, corporate acknowledgement that the problem isn't temporary. If inflation persists, many high-end buyers may downsize to smaller Class B or C rigs, leaving Newmar with excess production capacity. Building capacity is expensive. Idle capacity is financial poison. Newmar could survive, its quality reputation provides cushion, but current sales pace is unsustainable without deep price cuts or market recovery by late 2026. The brand faces a difficult choice: discount aggressively and damage premium positioning, or maintain prices and watch inventory pile up. Neither option is good. Forest River isn't a single brand. It's an empire encompassing Coachmen, East to West, Palomino, and many others. That diversification typically provides strength, but 2025's environment creates systemic risk across the entire operation. Statistical Surveys reports total U.S. towable shipments fell over 9% year-to-date in 2025, even as dealer lots remain dangerously overstocked. Forest River produces enormous volume, creating a mismatch between manufacturing output and actual retail demand. Multiple pressure points converge. Rising warranty claims drain profits, tighter dealer financing restricts inventory capacity, and thinning margins across budget lines threaten overall profitability. When problems compound across multiple sub-brands simultaneously, even large companies face consolidation pressure. Forest River's size allows survival, but internal sub-brands may be sacrificed to streamline operations and preserve capital. Expect the company to protect its strongest performers, Rockwood, Salem, and Flagstaff, while letting weaker divisions fade quietly through 2026. This isn't about Forest River collapsing, it's about contraction. The company will emerge smaller but hopefully more profitable. However, employees at underperforming brands face layoffs, dealers lose product lines, and communities dependent on manufacturing plants face economic disruption. Forest River's challenge: cutting enough to survive without cutting so much it loses market position to competitors. It's a delicate, painful balance. Tiffin, long considered the gold standard for handcrafted Class A motorhomes, now faces mounting pressure under Thor Industries ownership. Its flagship models like the Allegro Bus and Phaeton regularly exceed $500,000, placing them squarely in the luxury market segment that's collapsing fastest. The numbers are brutal. Class A registrations plunged over 20% in 2025 according to statistical surveys, with dealers nationwide reporting record inventory levels. Thor's latest quarterly filings show sharp profit drops in its high-end motorized division, forcing production slowdowns at Alabama and Indiana facilities. Tiffin's typical buyer, older, affluent retirees, is pulling back. Even wealthy consumers grow cautious amid inflation, stock market uncertainty, and higher financing rates. When six-figure discretionary purchases feel risky to millionaires, the market shrinks dramatically. Quality concerns compound the problem. Parts shortages and warranty delays have damaged Tiffin's once pristine reputation for service, a critical differentiator that justified premium pricing. Analysts now describe the brand as prestigious but overexposed. If demand for ultra-luxury rigs continues declining through 2026, Tiffin may need to cut production dramatically or temporarily idle manufacturing plants. Without pivoting towards smaller, more fuel-efficient luxury rigs, even this iconic half-century-old name could face its toughest chapter yet. Prestige alone can't sustain a business when customers stop buying. The smallest shift in this market could erase entire brands overnight. Have you seen RV prices collapsing in your area? Drop a comment below. Your story matters. And don't miss our next video, where we expose the real reason RV dealerships are going bankrupt faster than ever. Safe travels.